Good morning, everybody. It is Thursday, April 24th, and we're going to start our prep here for the ES and for the NASDAQ and cover a few other charts as well. Just a quick reminder that derivatives trading is inherently risky and past performance is not indicative of future returns. Now, with that out of the way, we will start with our website for our professional subscribers, and we'll go through some of these tools. Um, on our ES today, we have our bands, and we can see that the top edge of our band and the low edge of our band are sitting at 55.31 on the top end, and then the lower 52.23 with our rotational zone 54.24 to 52.90. We can also look at where our line in the sand is, and we're clearly below our line in the sand. That's this pink line right here, that horizontal line. And if we put on our minor line in the sand, we are sitting right at it. It's right at 53.90 here. That's right where we are. And if we go to our intraday chart as well, and we can turn these on and off for you here, we are right at VWAP, and in terms of our line in the sand, again below it and right inside of our rotational zone. And then we are below the line in the sand, so we look for those larger moves, and then you can look at your different pins for key areas. We have this as well for crude, gold, and the NASDAQ. So quickly here on the NASDAQ, again, we are nearing the top of our rotational level at the moment, which is 18,891 down to 18,346 for the rotational zone. Getting over that, we're going to look for 19,327 to 19,164. That's that upper level there. And you can see that's where we got to yesterday. We hit that. That's a good sell trade. And we made our move right back into the rotational zone from there. And then as well here, we are above actually both of our line in the sands on the NASDAQ. So our key area to watch today on the NASDAQ is 18,612. Staying above that ahead of earnings will dampen a lot of the moves compared to what we have seen. And getting below that, we will look for range expansions and bigger moves. And you can see where we came down to in the overnight here, right at that horizontal line. That's our line in the sand. And we came right down to it. And that's where we would expect the traders in Chicago to step in. And they did their job. As you can see, the wicks on those candles pushing us back up. Now, when we look at positioning, and we only get this one once a week on our COT report. But again, commercials did go long on the ES, on the SPX, and our active investment managers are pretty well flat on US equities. I mean, nearing lows that we've only seen during the GFC and COVID crises. And those bear markets. So we are getting a lot of cash on the sidelines, and that is also supported in our systematic strategies that they are as well pretty much no US equity exposures or very little. So out of a $600 billion strategy here, as well as a multi-trillion dollar strategy for active funds, this is a lot of money on the sidelines. And what that tells us is this move up this week is trying to entice people to come back into the markets as we have too much cash on the sidelines. And without demand, we can't really rise prices. But without a lot of supply, we can't drop the prices. So the supply is already gone. The cash is on the sideline. We can see that. So this is supporting more of that large chop that we've been in, 300 to 500 point weekly ranges on the ES. 1,500 to 2,000 point ranges on the NQ on a weekly basis. And until some of this positioning changes, that's what we are going to look for to continue. And then just to look at overall structure here, again, we do still have credit risk in the market as our high yield is over our spread, and that will put stress on bank balance sheets. And we're also getting a little bit of a bull flag showing up on our high yields. So that's something we want to pay attention to, because if that starts to break out, that is going to signal further downside for banks, bank ETFs like the KRE, and then the RTY as well, because small caps are going to be more susceptible to this than are the mega caps. Bond volatility is coming down. We will watch for a shift under 110 on the move for any changes. Otherwise, all else being equal here, bond auctions are still going to be highly volatile, and they're going to affect the dollar and our equity indices as well. until this equation starts to change. Multi-asset vol is pulling back as Trump has dialed down his rhetoric, but we still need to see the VIXN close below 40 and the VIX under 20 for any real changes to occur. So you can see here the VXN, so the VIXN, the NASDAQ volatility is still over 40, and we really need to see that come back under, and we need to see the and under 30 for the VIXN, and then the VIX, we want to see that blue line get under 20 over here. That's really what we want to watch. Otherwise, all asset vol is starting to come down except for GVZ. So gold vol, which spiked yesterday, and we saw the pullback. Now with a breakout to all-time highs, um, very bullish on the overall structure and that rise in volatility. That is a buying opportunity there on gold. And again, we can see these little micro changes throughout the different structure points here. And lastly, as we look into our correlations, we pointed this out that Bitcoin was starting to break away from the dollar. On our duration basis, it's now still coming down almost to flat. And when we look at our shortest time frame, our trading time frame for this, we are at negative 0.22. So we are getting a little bit of an inverse correlation. So we're looking for that signal to continue to break down to be able to use the dollar a little more for Bitcoin, but we are seeing that separation now that it is going into a uh, anti-dollar, anti-beta trade as opposed to more of a tech-based trade. Instead of mimicking the Nasdaq, now it's behaving on its own. So we're seeing that in Bitcoin. We're also seeing again still strong correlation with the VIX, but we are seeing that oil on duration. That signal is beginning to break down. So it was a correlated trade, and now we are seeing the ES and the oil trade and Nasdaq and oil trade, equity indices, oil. We're seeing that trade start to break down. Not near anything we can utilize at this point, but it is again another signal that we want to pay attention to. So be sure to watch your levels today, guys. Again, we went through the rotational zones, and that's what we would look for is back and forth in there. Bigger picture, we're still looking for wide range, wide chops, and you do have those upper ends today. And if you guys don't follow along on some of the levels, that's okay. But the biggest thing you have to control, again, is always your risk. You have to manage your risk because that's what keeps us in this game. And that's what will keep you safe as we go throughout. So we will be doing more of these, and we will be doing these live for our subscribers starting in the next few days and a couple weeks. And if you guys do have any questions, please put them in our Discord room. We're happy to try to help. Have a great day, everybody.